Japan just did something 72 hours ago that hasn't been seen in 40 years. Something that vaporized $7.3 trillion in market value in less than one trading day. And right now, at this exact moment, the contagion isn't slowing down. It's accelerating. $4 trillion. That's not the total damage. That's what's getting liquidated in the next 30 days alone. Not forecasted, not predicted, already in motion. Because what happened in Tokyo on January 21st, 2026 wasn't a Japanese event. It was a detonation. The first explosion in a sequence that has repeated itself with perfect precision every single time a major economy crosses the threshold from unsustainable debt to bond market revolt. And once that threshold is crossed, once the sequence begins, it never reverses. It only compounds faster and more violently than anyone projects. Here's the exact timeline. January 20th, Japan's Prime Minister Saitake calls a snap election for February 8th. That's 2 days from now, and she makes voters a promise they can't refuse. Suspend the 8% consumption tax on food, massively increase government spending, more stimulus packages, more social benefits, more of everything. Sounds incredible, right? Free money for everyone. Except there's a mathematical problem that bond markets understood instantly. Japan's national debt is currently sitting at 237% of GDP. Not 100%, not 150%, 237%. The United States is at 125%, and economists are calling that a crisis. Japan is almost double that, and the government just promised to cut revenue and explode spending with zero plan to fund any of it. Which means one thing and one thing only: more debt, more bonds, more borrowing from a market that's already holding $13 trillion in Japanese government obligations. Bond markets heard that announcement and said no, violently, immediately, without hesitation. January 21st, the day after that election announcement, the Japanese bond market didn't just decline, it collapsed. The 40-year Japanese government bond yield spiked 25 basis points in a single trading session. If you don't understand bond markets, let me translate that. The 40-year yield normally moves by fractions of a basis point per day. Sometimes it takes 3 months to see a 10 basis point move. They moved 25 basis points in 6 hours. That's not volatility, that's a structural break. The 30-year yield jumped 30 basis points in the same session, hit 3.9%, highest on record in the history of that maturity. The 10-year went to 2.35%, highest level since 1999, all in one day, one session. The most violent repricing of sovereign debt we've seen since the United Kingdom's Liz Truss moment in September 2022. And here's what every financial analyst is either missing or deliberately not saying. This isn't a Japanese problem, this is a global detonation. Because Japan holds over $1 trillion in United States Treasury securities. They are the largest foreign holder of American debt, larger than China, larger than everyone. And when Japanese bond yields spike from near 0 to 4%, Japanese investors suddenly have a choice they haven't had in 20 years. Why would you buy US Treasuries yielding 4% when you can get Japanese government bonds yielding the exact same 4% in your home currency with zero exchange rate risk? You wouldn't. So what do? They sell US bonds. They liquidate Treasury positions. They repatriate capital. And when the largest foreign buyer of US debt becomes an active seller, US yields don't stay stable. They spike hard. The day after Japan's bond market collapsed, US 10-year Treasury yields jumped 6 basis points. The 30-year moved even more. That's not correlation. That's mechanical contagion. That's the transmission mechanism activating in real time. But it gets so much worse than just rising yields, because every single financial asset on this planet is priced relative to risk-free government bond rates. Stocks, real estate, corporate bonds, every investment, every retirement account, every asset is valued using a discount rate tied to sovereign yields. When those yields explode higher by 100 basis points, by 200 basis points, everything else doesn't stay the same price. Everything reprices lower violently, simultaneously, globally. The mathematics on this are brutal and non-negotiable. $4 trillion is the conservative floor estimate for what's about to liquidate. Not the ceiling, the floor. And by the time the sequence fully plays out, we're looking at $6 trillion to $8 trillion in destroyed asset value across equity markets, bond markets, real estate, credit instruments, currency devaluations, everything, all at once, starting right now. Now let me show you why this is inevitable, why this isn't just a bad couple of weeks in Japanese bonds, why this is the beginning of a pattern that has played out 17 times in modern financial history with perfect consistency. Because once you see this pattern, once you understand the mechanism, you'll know exactly what comes next. And more importantly, you'll understand why repositioning needed to happen yesterday. There's a sequence, 4 stages. Every single time a developed economy with massive debt faces loss of bond market confidence, The sequence is identical. The speed changes. The specific trigger changes. But the sequence never changes. Same pattern, same outcome. Stage 1 is the setup. This is where a government accumulates debt beyond any sustainable threshold. Not just high debt, unsustainable debt, where interest payments start consuming 20%, 30%, 40% of total government revenue, where debt to GDP ratios enter levels that historically precede systemic crisis. Japan spent 3 full decades building to this point, 30 years of endless deficit spending, stimulus package after stimulus package that never generated real growth, promises to retirees and voters that could never be funded through actual taxation, just borrowing and borrowing and borrowing until the debt reached 237% of GDP. That's the setup, creating a situation where the only way to service existing debt is to issue more debt, a debt spiral. And everyone knows what happens to spirals. They accelerate until something breaks. Stage 2 is the dependency. This is where the government becomes completely dependent on bond markets staying calm, dependent on yields staying artificially low. Because if yields rise by any significant amount, the interest cost doesn't just increase, it explodes exponentially. Japan's national debt is roughly $13 trillion. At 1% average interest rates, that's $130 billion per year in interest payments. Expensive, but manageable. At 4% interest rates, that same debt costs $520 billion per year. That's almost 1/4 of Japan's entire annual government budget. Just interest. Not paying down principal, not funding programs, just interest on existing debt. So governments in stage 2 do everything possible to suppress yields. Central bank bond buying, yield curve control, financial repression, threatening banks to buy government bonds, whatever it takes. And it works for years, sometimes decades. Yields stay pinned near zero. Markets stay calm. Everyone convinces themselves it's sustainable forever. Stage 3 is the break. This is where confidence shatters. Something triggers the market to suddenly question whether the debt is actually sustainable. Could be a political event, could be a policy announcement, could be a change in central bank strategy, could be an election promise that makes no mathematical sense. Doesn't matter what specifically triggers it. What matters is the psychology shifts instantly from calm acceptance to questioning, from complacency to fear. And when confidence breaks in sovereign bond markets, the repricing isn't gradual. It's violent, fast, brutal, because bond markets are the deepest, most liquid, most leveraged markets in the entire world. When they move in massive size. Billions liquidated in hours, yields spiking, prices collapsing. And once the break starts, it feeds on itself. Selling begets more selling. Rising yields beget more rising yields, a cascade that accelerates. Stage 4 is the contagion. This is where the crisis that started in one country's bond market spreads globally. Because modern financial markets aren't isolated. They're connected, integrated, correlated. When Japanese yields spike, it affects U.S. Treasury markets immediately. When U.S. Treasury markets get hit, it affects European bond markets. When all developed market bonds reprice higher simultaneously, it affects emerging markets. Their currencies crash, their stocks collapse, their credit spreads blow out. Everything reprices at the same time. And wealth transfers massively from those holding assets in the affected currencies to those holding hard assets, from those who didn't see it coming to those who did. Now, let me show you this exact pattern in action. 3 times, 3 major economies, same sequence, same outcome. Then we'll apply it to Japan today, and you'll see exactly where we are in this sequence and what's coming in the next 30 days. United Kingdom, September 2022. Liz Truss became Prime Minister on September 6th. She campaigned on tax cuts and deregulation, growth at any cost. Within 3 weeks, her Chancellor Kwasi Kwarteng announced what they called the mini-budget, September 23rd. $45 billion in unfunded tax cuts, abolish the top income tax rate, slash corporate taxes, cut stamp duty on real estate, all of it with 0 identified spending cuts or revenue sources to pay for any of it. The market reaction was immediate and catastrophic. Stage 1 had been building for years. Brexit uncertainty from 2016 onwards fractured confidence. COVID spending exploded the deficit. Government debt went from 85% of GDP to over 100%. Not catastrophic by itself, but trending in the wrong direction fast. Stage 2 was Bank of England quantitative easing. They had purchased $437 billion in government bonds over a decade, kept yields artificially suppressed. Markets became completely dependent on that support continuing forever. Then Truss triggered Stage 3 in the most spectacular fashion possible. September 26th, just 3 days after the mini-budget announcement, UK government bond yields exploded. The 30-year gilt yield spiked from 3.5% to 4.5%. That's 100 basis points in 72 hours. Pension funds holding those bonds as collateral suddenly faced massive margin calls. They used a strategy called liability-driven investing. leveraged positions in long-dated government bonds. When bond prices collapsed overnight, their leverage turned toxic. They were forced to sell more bonds to meet margin requirements. That selling pushed yields even higher, a doom loop. Classic Stage 3 dynamics. By September 28th, pension funds were in existential crisis. They managed $3 trillion in assets for British retirees. If they were forced to liquidate at fire sale prices, the entire UK financial system faced systemic collapse risk. The Bank of England had no choice. Emergency intervention. They announced unlimited purchases of long-dated bonds on September 28th, whatever it took to stop the spiral. Simultaneously, trusts came under enormous political pressure. By October 14th, Kwarteng was fired. By October 20th, Truss announced her own resignation. 44 days as Prime Minister, shortest tenure in British history, but the damage was already permanent. Stage 4 cascaded across markets. Sterling crashed from 1.12 against the dollar to 1.03, nearly at parity, a 20-year low. UK stocks, the FTSE 100, dropped 15% from September highs. Real, permanent damage to pension values. Mortgage rates spiked from 3% to over 6% in a matter of weeks. Housing transactions froze completely. Prices started falling immediately, and wealth transferred massively, from bondholders who bought at low yields to those who bought the crash, from homeowners facing unaffordable remortgages to cash holders, from pension funds to predatory hedge funds who saw the crisis coming and positioned accordingly. The wealth transfer was measured in hundreds of billions of pounds in 6 weeks, all because a government announced fiscal policies that bond markets deemed mathematically unsustainable. Greece, 2010 to 2015. The sovereign debt crisis that nearly destroyed the euro itself. Stage 1 was a decade of deception. Greece joined the euro in 2001, suddenly had access to German-level interest rates. Before the euro, Greek government bonds yielded 7% to 8%, reflecting actual default risk. After joining the euro, yields dropped to 3% to 4%, exact same as Germany. Markets treated Greek debt like German debt. Fatal assumption. Greece borrowed massively, funded pension systems they couldn't afford, hired government workers excessively, ran deficits every single year. Debt to GDP went from 103% in 2001 to 129% by 2009, all funded at artificially low rates that made it seem sustainable. Stage 2 was complete dependency on bond market complacency. The Greek government needed to roll over roughly $50 billion in maturing debt every single year, plus fund annual deficits of $30 billion to $40 billion. That's $80 billion to $90 billion in annual borrowing requirements. As long as markets stayed calm, as long as yields stayed low, this was manageable. Greek banks bought Greek government bonds. European banks bought them. Everyone assumed the euro provided an implicit backstop. Then in October 2009, the newly elected Prime Minister George Papandreou revealed the truth. The budget deficit wasn't 6% of GDP as previously reported to the EU. It was actually 12.7%, double. They had been systematically lying about the numbers for years. Stage 3 detonated immediately. December 2009 into 2010, Greek bond yields spiked from 5% to 12% in a matter of months. By April 2010, yields hit 21%. Markets were pricing in significant default probability. The Greek government couldn't borrow at those rates, couldn't fund basic operations, couldn't pay pensions or government salaries. May 2010, the European Union and IMF provided a $110 billion bailout. But that didn't solve the underlying problem. It just bought time. By July 2011, yields were back at 25%. Another crisis, another bailout required. $130 billion stars, still not enough. By March 2012, Greece was forced into the largest sovereign default in human history. Private bondholders took a 75% haircut. $100 billion in losses vaporized overnight. Stage 4 consumed all of Europe. Portuguese yields spiked from 4% to 16%. Ireland required an $85 billion bailout. Spain's borrowing costs hit 7%, the level universally considered unsustainable. Italian yields approached similar crisis levels. The entire European banking system faced potential insolvency because banks across the continent held enormous positions in peripheral European sovereign debt. Stock markets crashed continent-wide. The euro itself was questioned. Existential crisis. The European Central Bank was ultimately forced into unlimited bond buying. Mario Draghi's famous "whatever it takes" speech in July 2012. They purchased sovereign bonds of Spain and Italy to artificially cap yields. That prevented full systemic contagion. But the damage to Greece was permanent and catastrophic. Greek GDP fell 25% from 2008 to 2013. Not a recession. A depression. Unemployment hit 27%. Youth unemployment went above 60%. Pensions were cut 40% to 50%. An entire generation saw their wealth destroyed. Property values crashed 50% to 70%. Banks imposed capital controls. Citizens couldn't withdraw more than $60 per day from ATMs. Meanwhile, German banks and hedge funds that had shorted Greek debt or bought Greek assets at bankruptcy liquidation prices made absolute fortunes. Wealth transfer measured in hundreds of billions of euros, from Greek citizens to foreign creditors, all because bond markets lost confidence in fiscal sustainability. Once Stage 3 started, nothing could stop Stage 4. Japan, 1990 to 2003. The original debt crisis that set up today's situation. Stage 1 was the 1980s bubble. Japanese real estate and stock markets went absolutely parabolic. The Nikkei hit 39,000. The grounds of the Imperial Palace in Tokyo were theoretically worth more than all of California. Debt-fueled speculation everywhere. Then the bubble burst in 1990. The Nikkei crashed 75% over 13 years. Real estate fell 60% to 80%. But the government didn't let the system cleanse. They intervened. Massive stimulus, infrastructure spending, bank bailouts, all debt financed. Debt to GDP went from 50% in 1990 to over 150% by 2003. Stage 2 became permanent policy. Near zero interest rates for decades. Bank of Japan buying government bonds to keep yields suppressed. Yield curve control. Whatever it took to keep borrowing costs at zero. Because any meaningful rise in rates would bankrupt the government through exploding interest costs. This worked for 20 years. Yields stayed near zero, but the debt kept growing and growing and growing to today's 237% of GDP. Stage 3 is what just happened. January 20th, 2026. Bond markets said no more. Yields exploded, confidence broke. And Stage 4 is starting right now, today, this moment. See the pattern? Setup, dependency, break, contagion, United Kingdom, Greece, Japan in the 1990s, same sequence, different decade, identical outcome. And it's happening again in Japan right now, except this time it's bigger, much bigger. Because Japan isn't a peripheral European economy like Greece. Japan is the world's fourth largest economy with $13 trillion in government debt, holding $1 trillion in U.S. Treasuries, integrated into every single global financial market. When Japan's bond market breaks, the contagion isn't regional, it's global, it's immediate, it's unstoppable. Now, let me walk you through exactly where we are in this sequence using Japan today, so you see what just happened, what's happening right now, and what comes next in the next 48 hours. Stage 1, setup. Japan's debt to GDP at 237%, built over 3 decades. Everyone knew it was unsustainable mathematically, but as long as yields stayed at zero, it was manageable. 1% interest on $13 trillion. Expensive but payable. Check. Setup complete. Unsustainable debt load created. Stage 2, dependency. Bank of Japan implemented yield curve control in 2016. Unlimited bond buying to keep 10-year yields below 0.25%. This lasted from 2016 to March 2024. 8 years of complete artificial suppression. Markets became entirely dependent on the Bank of Japan being the buyer of first and last resort. Over 50% of all Japanese government bonds are owned by the Bank of Japan, not private investors, not pension funds, the central bank. When your central bank owns half of your own government's debt, that's not a market. That's a control mechanism. Check. Dependency established. System requires artificial life support to function. Stage 3 is the break, and it's where we are right now. The timeline matters. In March 2024, the Bank of Japan ended negative interest rates after 8 years and began reducing bond purchases. Markets grew nervous but held together. Then, on January 20th, 2026, Prime Minister Takai called a snap election and promised tax cuts and more spending without explaining how it would be funded. The bond market revolted immediately. On January 21st, 40-year yields jumped 25 basis points, 30-year yields surged, and 10-year yields hit 2.35%, the highest since 1999. This wasn't a one-day panic. Weak auctions followed, buyers disappeared, and volatility spread. By late January, U.S. officials were warning about contagion. By early February, demand had deteriorated further. Stage 3 is active right now, and now Stage 4 is beginning. Contagion. Japanese investors hold over $1 trillion in U.S. Treasuries. With domestic bonds now yielding 2% to 4% in yen, they're selling U.S. debt and bringing money home. That selling is already pushing U.S. yields higher and triggering a feedback loop. Rising yields are pressuring stocks, credit, currencies, and real estate simultaneously. Equity valuations are stretched, credit spreads are widening, the yen is weakening, housing is freezing. History is clear. Once Stage 4 begins, it doesn't stop until forced intervention or systemic reset ends it. And here's the problem. Japan has already tried intervention. For 8 straight years, the Bank of Japan relied on yield curve control, unlimited bond buying, and balance sheet expansion. It worked temporarily until it didn't. When markets lose confidence in a sovereign borrower carrying 237% debt to GDP, no central bank can restore that trust permanently. The UK tried, and it lasted 2 weeks. Greece tried, and it ended in default and bailout. Japan is trying now, and markets are calling the bluff in real time. This leads to the three biggest myths people cling to, the three beliefs that convince investors this time is different, and the same beliefs that end up costing them everything. The first myth is that Japan's debt is safe because it's domestically held. More than 90% of Japanese government bonds are owned by local institutions like banks, insurance companies, pension funds, and the Bank of Japan itself. The argument is that Japan owes the money to itself, so a crisis can't happen. That sounds reassuring, but it's dangerously wrong. Debt mathematics doesn't change based on who owns the bonds. If yields rise from 1% to 4%, interest costs still quadruple. Domestic institutions are not charities. They are profit-driven and risk-sensitive. When better returns appear elsewhere with less risk, they reduce exposure. And that is already happening. Banks are cutting holdings. Insurers are trimming portfolios. Pension funds are shifting capital overseas. Domestic holders can trigger a crisis just as easily as foreign investors. The second myth is that the Bank of Japan can simply buy everything. With an unlimited balance sheet, it can print whatever is needed and suppress yields forever. Except it already tried that for 8 years and it failed. When a central bank monetizes government debt, it creates inflation. Japan has been above its 2% target for 4 consecutive years. Inflation is already elevated. Restarting massive bond buying would weaken the yen further, drive up import costs, and accelerate energy inflation in a country that imports most of its fuel. Inflation would push toward 5%, 6%, or 7%. And at that point, public pressure would force policy tightening. The cure becomes worse than the disease. The third myth is that this is just election noise and that once the vote passes, markets will calm down. History says otherwise. Elections don't solve structural debt problems. The UK changed governments. Greece held multiple elections. Nothing changed. Mathematics doesn't care who wins. Japan's debt remains at 237% of GDP regardless of politics. If the ruling party wins, spending increases. If the opposition wins, spending increases under a different label. Either way, more bonds are issued, supply rises, and yields stay elevated. This isn't a political crisis, it's a mathematical one. And mathematics always wins.